This is Matthew Kratter's Bitcoin University. Today I want to talk about corporate Bitcoin adoption and the huge wave of buying that will be coming to Bitcoin from corporations. And this video is loosely based on the first 10 or 15 minutes of this interview that Matt Odell did with Michael Saylor over at Bitcoin Park in Nashville. And I encourage you to watch the whole interview. It's really, really good. And it brought together a lot of things for me that I want to share with you in this video. There's this distinction between operating companies and investment companies when it comes to regulation in the US. Operating companies, the focus is on the actual operating business, for example, companies like Apple, McDonald's, Nvidia, etc. And then you have investment companies where the focus is on pooling investors' money and then using that money to buy securities like stocks. And an example of an investment company would be a mutual fund. Now, under the U.S. Investment Company Act of 1940, an operating company can be forced to reclassify as an investment company if 40% or more of the total assets are securities like stocks being held on its balance sheet. That's a legal and accounting nightmare and has lots of implications. So even if you're still a company that sells widgets, if you hold too many securities on your balance sheet, if you exceed that 40% or reach that 40%, you will become subject to registration and other requirements under the 40 Act. I'll put a link in the description notes below to the Investment Company Act of 1940 so you can study the history. The one carve out from this 40% requirement is, surprise, surprise, things like US dollar cash holdings, money markets, and of course, US treasuries, US government bonds. This is a perfect example of how regulation is used by governments to force corporations to hold their toxic sludge government bonds. And this can help to explain why companies hold cash and US treasuries on their balance sheets rather than investing all of that money into something else like a diversified stock index fund. Now, why is it a bad thing to be forced to hold so much US dollar toxic bond sludge? Because it's like having a melting ice cube on your balance sheet. Your corporation's savings are being surreptitiously drained by the quote-unquote inflation tax. If you're finding this video helpful so far, I just pause here briefly to ask you to help to support the channel and to help me with the YouTube algorithm so this message can get out to more people. Hit the subscribe button, leave a like, leave a comment, share this video with a friend or a family member. And then if you want to further help with the YouTube algorithm, you can also leave a tip, leave a super thanks. And also you can join the channel, click the join button after subscribing, and you'll see a couple options where you get extra videos every month, etc. Now, your company's economic energy is being siphoned off and used to fund government deficit spending via the mechanism of central bank money printing and bond purchases. If your company is holding U.S. government bonds, you're holding a melting ice cube in terms of purchasing power. So, for example, if your company is holding, let's say, $277 billion worth of cash, you're basically bleeding out about $22 billion every single year if we use 8%, which has been the average, 7 or 8%, the average US dollar money supply growth. And we use this as an estimate of long-term inflation. In other words, how quickly those ice cubes are melting on your balance sheet. Now, some of this can be offset by the coupon payments that government bonds offer at times, or the capital appreciation that you experience with zero coupon T-bills, where you buy them at a discount and then they mature at par. But the closer interest rates are to zero, the more quickly your company is bleeding out. And this is one reason among many why most companies fail within 10 years. They're unable to retain their economic energy. And rather than choosing to hold government bonds, which they know to be a dumb idea, they'll often make additional other foolish capital allocation decisions like buying other companies, M&A, to try to get rid of that cash. Or they'll just return the cash to shareholders as dividends or stock buybacks rather than holding it in government bonds. And then if they return too much cash, they won't be prepared for the inevitable next economic or business downturn. They won't be prepared with enough cash holdings on their balance sheet. So this is the problem that U.S. corporations and really corporations globally face. And this is the problem that even companies like Berkshire Hathaway faces. That example of holding $277 billion worth of cash on your balance sheet, I took from Berkshire Hathaway. And so I imagine Buffett here is waiting to make some monster purchase of a private company, but he's unable to hold all of this in security, so he couldn't buy a stock index fund, for example, while he waits. Now, fortunately, Bitcoin fixes this. This doesn't fix it for old dinosaurs like Buffett who don't understand Bitcoin, but it fixes it for corporations. In the US and most of the world, Bitcoin now has regulatory clarity as a digital asset. It's not classified as a security, so there are no limits to how much of it a company can hold on its balance sheet before it falls subject to the 40s the 40 Act, as I understand it. So the logical choice for CEOs and CFOs of companies to make is to replace some or all of their government bonds with Bitcoin as a store of value on their balance sheet. This is, of course, what MicroStrategy has done in a big way. If MicroStrategy had allocated instead their excess cash to U.S. government bonds instead of Bitcoin, there's a very good chance they would have gone out of business when the Fed hiked interest rates a few years ago. Instead, this happened. They outperformed everything, including Bitcoin, because they were using leverage. MicroStrategy up over 1,200% since August 10th, 2020, when they adopted their Bitcoin strategy. And we can see the close second is Bitcoin itself. But if they'd been holding bonds, they'd be down at least 18% on those bond holdings. And for an operating company like MicroStrategy, this could have been deadly to the company. One major drawback of holding Bitcoin on your corporate balance sheet has been the accounting treatment of it. If Bitcoin goes down, you have to mark it down on your balance sheet, and the temporary loss then flows through to the income statement, making it look like your company is losing money. And this was a misunderstanding that occurred a lot surrounding MicroStrategy during the bear market. They hadn't sold their Bitcoin, they were still hodling it, but those paper mark-to-market losses were flowing through to the income statement. And then the other problem with the old accounting of Bitcoin was if Bitcoin then goes back up, you can't mark it back up on your balance sheet. So it's stuck on your corporate balance sheet at that depressed value forever. Now, fortunately, that all changed in January 2024. Companies like MicroStrategy can today and are using this new fair value accounting for Bitcoin, where they don't have to mark it down like that, and they can also mark it up if Bitcoin's price appreciates in terms of fiat. This is available, I believe, to any company already, and it'll become mandatory beginning early next year. Now, there's one missing piece. U.S. regulators need to allow all U.S. banks to custody Bitcoin, or at least the too big to fail banks, allow them to custody Bitcoin. Right now, it's just Coinbase custody and a few other custodians, and no corporate CFO wants to hold their Bitcoin with Coinbase custody or no-name banks, especially while Gensler and the SEC are still suing Coinbase and trying to put it out of business. This is not something the Apple CFO would be comfortable doing, wiring $50 billion to Coinbase and holding it there in the form of Bitcoin. Now, this will certainly change under a Trump or RFK Jr. administration. It's possible to change under a Harris administration, though it seems less likely. She sort of appears with her people to be digging in her heels and being anti-Bitcoin and anti-crypto. But nevertheless, the conclusion here is all the pieces are coming together to make it much easier for corporations to hold Bitcoin on their balance sheets in place of some or all of their government bonds and other cash holdings. This will make these corporations much more robust because they won't be constantly bleeding out 8% of their savings every year through the inflation tax. Corporations will be yet another enormous source of demand for Bitcoin, and they'll probably be buying a lot of Bitcoin BTC itself rather than the spot Bitcoin ETF, since the spot Bitcoin ETF is certainly a security and thus would count toward that 40% of assets on the balance sheet that could be held in securities. You can only imagine what's going to happen to Bitcoin's price when every corporation in the S&P 500, especially the tech behemoths like Apple, Google, Nvidia, start allocating to Bitcoin and take their tens or hundreds of billions of dollars worth of cash and U.S. treasuries and take a percentage of that and put it into Bitcoin, especially because they're going to be competing with each other, and Bitcoin has this very, very scarce supply. So this will be yet another huge driver of Bitcoin's fiat price appreciation over the coming years. If you enjoyed this video, be sure to hit the subscribe and like buttons. Hit the notification bell if you want to be notified when I publish that next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.